Silver appears to be repeating 2011, but what if that comparison is completely wrong? Because beneath the charts, something far more important may be developing. The same type of correction that appeared before silver's historic 2011 peak also appeared in 2008, and the outcome was dramatically different. If this really is a 2008 style cycle, the biggest move may still be ahead, and the next financial trigger could reveal which cycle silver is actually following. Welcome to Next Alert. If this channel brings useful market analysis, consider subscribing, especially if you've been following gold and silver for years. And let us know in the comments, where are you watching from today? Silver's recent behavior has created a familiar fear across the precious metals market. After a powerful advance, the metal entered a sharp correction, producing a pattern of lower highs and lower lows that looks remarkably similar to the breakdown that followed silver's 2011 peak. At first glance, the comparison appears convincing. In 2011, silver had experienced an extraordinary rise before momentum weakened, and the market began falling. Today, another major advance has been followed by a correction, raising the obvious question, is history preparing to repeat itself? That question matters far beyond the silver market. For investors, business owners, and anyone trying to protect capital during periods of monetary instability, identifying the type of cycle taking place can determine whether a correction represents the beginning of a long decline or simply a temporary reset before another major advance. The problem is that charts can create a dangerous illusion of certainty. Two periods can look almost identical while developing under completely different economic conditions. Price patterns show what the market has done. They do not automatically explain why it happened, what forces are operating underneath it, or what those forces could produce next. That distinction becomes particularly important when comparing 2011 with 2008. The 2011 decline eventually developed into a prolonged bear market for precious metals. But the correction that occurred around 2008 followed a very different path. After a severe decline, gold and silver eventually entered another powerful phase that ultimately contributed to the historic peak reached in 2011. That means the same basic visual signal, a major rally followed by a significant correction, can produce completely different outcomes depending on the financial environment surrounding it. This is where the current silver cycle becomes much more interesting. When the current correction is placed beside both historical periods, the picture becomes less straightforward. Silver's trajectory does not uniquely match 2011. In several important respects, its behavior also resembles the 2008 correction, particularly when the depth and timing of the decline are examined rather than simply comparing the shapes of two charts. And that creates a much bigger question. What if the market is not repeating the final stage of the previous cycle? What if it is repeating the correction that came before the final major advance? The distinction is enormous. A 2011 style interpretation would suggest that the major move has already occurred and that investors should prepare for a much longer period of weakness. A 2008 style interpretation suggests something very different, that the correction may be clearing the excesses of the previous advance while positioning the market for another, potentially much larger move. But price alone cannot settle that debate. To understand which historical cycle is actually more relevant, the analysis has to move beyond silver. Gold must be examined alongside it because gold has historically provided an important signal about the broader direction of the precious metals market. And beyond gold lies an even larger factor, the financial system itself. Debt levels, currencies, government bonds, central bank behavior, liquidity, and emergency interventions can change the meaning of a chart completely. That is why the real question is not whether today's silver chart resembles 2011. The real question is whether today's financial system resembles 2011 at all, and that is where the comparison between 2008 and 2011 begins to reveal a very different story. The most dangerous mistake in a precious metals cycle is to watch silver in isolation. Silver attracts attention because it moves faster, reacts more violently, and often produces the most dramatic headlines. But historically, the larger signal has frequently appeared somewhere else first, in gold. That relationship becomes critical when the current market is compared with 2008 and 2011. During a major precious metal cycle, gold can act as the early warning system, while silver behaves more like a high beta response. Gold establishes direction, monetary confidence begins shifting, and silver eventually amplifies the move. That is why the current correction cannot be judged simply by asking whether silver has fallen enough to resemble 2011. The more important question is what gold was doing during comparable stages of the previous cycles, and this is where the historical comparison becomes surprisingly different. In the 2011 environment, the precious metals market was approaching the culmination of an enormous multi-year advance. The financial system had already experienced extraordinary intervention. The worst phase of the global financial crisis had passed, and markets were increasingly focused on the consequences of the earlier crisis rather than its initial shock. The environment surrounding 2008 was fundamentally different. The financial system was breaking under pressure. Credit markets were deteriorating, confidence was weakening, Governments and central banks were being forced into increasingly aggressive responses. What initially appeared to be a devastating correction eventually became part of the foundation for another major precious metals advance. That distinction matters because a correction does not exist independently from the system producing it. A falling silver price can mean exhaustion. It can also mean liquidation. It can mean investors are raising cash during a period of stress, or it can mean the market is temporarily clearing positions before the underlying monetary forces become even stronger. The chart itself cannot identify which explanation is correct. Gold can provide another piece of the puzzle. If gold remains structurally stronger while silver struggles, that can indicate that monetary demand has not disappeared. Instead, capital may simply be moving toward the more established monetary asset before eventually flowing into the higher volatility portion of the precious metals market. That is exactly why the relationship between the two metals deserves greater attention. The current cycle also contains another important feature: the speed of the correction. Historical corrections do not always unfold at the same pace. A faster and deeper decline can actually resemble the early stages of 2008 more closely than the slower deterioration associated with 2011. That does not guarantee a repeat of 2008. History rarely repeats with perfect precision, but it can reveal the type of environment investors are entering. And the difference between these two historical benchmarks is becoming increasingly important. If the current cycle were simply a replay of 2011, the broader financial system would need to resemble the conditions that existed after the major crisis had already been contained. But if the current cycle is closer to 2008, then the correction could be occurring before the most consequential phase of the monetary response. That would completely change the interpretation of weakness in silver. Instead of asking when the precious metals bull market ends, investors would have to ask whether the market is preparing for the next stage of it. And that question leads directly into the part of the story that price charts cannot explain. Because the biggest difference between 2008, 2011, and the current cycle may not be silver's price at all. It may be the financial system standing behind it. The most important clue in this cycle may not be found in a silver chart at all. It may be found in the behavior of the financial system. That is where the comparison between 2008 and 2011 becomes far more revealing. The two periods were separated by only a few years, yet they represented very different stages of the same broader crisis. In 2008, the system was still discovering how fragile it had become. The crisis began with housing and credit, but its consequences quickly moved through banks, financial markets, government balance sheets, and eventually sovereign debt. Emergency intervention became necessary because allowing the financial system to unwind without support threatened much more than individual institutions. And this matters for silver because precious metals were not simply reacting to charts. They were reacting to confidence. When confidence in financial assets weakens, investors begin questioning the safety of currencies, government debt, banks, and other forms of paper wealth. Gold becomes increasingly important in that environment because it carries no corporate balance sheet and no promise from a borrower. Silver can eventually benefit from the same monetary forces, but with greater volatility. The sequence is therefore important. First comes financial stress, then intervention, then the realization that intervention itself can create new distortions, then, potentially, another wave of demand for monetary assets. That sequence helps explain why the 2008 correction should not automatically be interpreted as the end of the precious metal story. The situation in 2011 was different. By then, much of the initial emergency response had already taken place. Governments and central banks had spent years attempting to stabilize the system. The market was dealing with the consequences of the crisis rather than standing at its original point of discovery. The result was a very different environment for precious metals. That distinction creates an important problem for anyone trying to label the current market as simply another 2011. If the present environment contains renewed financial stress, elevated debt, currency pressure, and the possibility of further intervention, then the historical analogy may be pointing in the opposite direction. The issue becomes even more significant when sovereign debt enters the picture. For years, major countries accumulated enormous quantities of government bonds as reserve assets. The assumption behind that strategy was straightforward. Sovereign debt, particularly U.S. debt, represented one of the safest and most liquid places to hold reserves. But when major financial pressures begin affecting currencies and bond markets, that assumption becomes less comfortable. A central bank holding a large foreign debt position has to consider not only the return on that asset, but also the strategic risk of remaining heavily dependent on another country's financial system. That is where gold becomes more than an investment. It becomes a reserve diversification tool. And if more central banks gradually decide that gold deserves a larger position while reducing their dependence on sovereign debt, the consequences extend far beyond the gold market. They create a structural source of demand that did not exist in the same form during earlier cycles. This is why the current environment deserves careful attention. A financial system can be temporarily stabilized without being fundamentally repaired. An intervention can stop an immediate crisis while simultaneously creating incentives for the next one. And a currency can remain dominant while still losing relative confidence at the margin. Those distinctions are easy to miss when the analysis focuses only on whether silver is rising or falling. The deeper issue is whether the system is moving toward resolution, or whether another round of intervention is only beginning. If it is the second possibility, then the current silver correction could represent something very different from the final decline of 2011. It could be the quiet phase before the financial system creates the next major catalyst. And that brings the analysis to the most important question of all. What happens to gold and silver when investors stop reacting to the correction and start reacting to the next intervention? The next major move in silver may not begin with silver. It may begin somewhere else in the financial system. That is the central lesson from the 2008 comparison. Major precious metals advances rarely develop in isolation. They emerge when several pressures begin moving in the same direction. Debt becomes harder to manage, currencies become less stable, bond markets become more fragile, and confidence in traditional assets begins to weaken. That combination creates something far more powerful than a simple technical breakout. It creates rotation. Capital begins searching for protection. At first, that rotation may favor gold. Gold tends to attract attention when monetary uncertainty rises because it has already established itself as a reserve asset. Silver often comes later, but when it does, its smaller market and greater volatility can produce a much faster move. This is why the current correction deserves to be viewed differently. If silver were truly entering a 2011-style decline, the broader financial environment would eventually need to support that interpretation. The system would need to demonstrate increasing stability, declining systemic pressure, and a convincing return toward resolution. But if financial stress continues to produce intervention, the equation changes. A weak currency can encourage demand for monetary metals. Bond market instability can encourage reserve diversification. Debt expansion can increase concerns about future purchasing power, and renewed liquidity can eventually flow into assets that benefit from monetary expansion. None of these forces guarantees a straight line rise. In fact, another decline in silver remains possible. That creates the first scenario. Silver could revisit important support levels before the larger trend resumes. Such a move would not automatically invalidate the broader bullish thesis. It could simply represent another stage of consolidation as speculative positions are removed and stronger capital waits for confirmation. The second scenario is more aggressive. The correction may already have established the important low, allowing gold to regain momentum first and silver to follow. If that happens, the market could move quickly because investors who waited for deeper prices would suddenly find themselves chasing an advancing market. The third scenario is the most important from a macro perspective. A new financial disruption could force another round of intervention. That disruption could emerge from currencies, government bonds, equities, credit markets, or several areas simultaneously. The precise trigger is impossible to know in advance, but the market's response may be easier to understand. When governments and central banks intervene to protect financial stability, they can temporarily suppress the symptoms of a crisis while increasing the amount of liquidity and debt inside the system. For precious metals, that distinction matters. The market does not necessarily need a collapse. It needs a reason for investors to question whether the existing monetary framework can continue operating without further intervention. That is why the most important indicators from here are not simply the daily silver price. Serious market observers should watch gold's leadership, silver's response to major resistance levels, the direction of the US dollar, sovereign bond yields, central bank gold purchases, liquidity conditions, and evidence of financial system intervention. Together, these indicators can reveal whether the market is moving toward another 2011-style resolution or deeper into a 2008-style intervention cycle. And there is one final point that business owners and investors should understand. The objective is not to predict the exact day silver reaches its next major high. The objective is to recognize the regime before the majority recognizes it. If the 2011 analogy is correct, the current weakness could eventually prove to be the beginning of a much longer period of disappointment. But if the 2008 analogy is closer to reality, the correction may ultimately be remembered for a very different reason. It may have been the period when the market temporarily moved backward, just before the financial system created the conditions for its next major move forward. That is why the current correction should not be judged by fear or excitement. It should be judged by evidence, because the decisive question is no longer whether silver looks like 2011. The decisive question is whether the world is preparing for another round of financial intervention. And if that intervention arrives, the correction that looks dangerous today could become the very setup that makes the next silver move impossible to ignore.